For the first time ever, U.S. revenue from customs duties has crossed the $100 billion mark this fiscal year. And it's still climbing, but this is fueled by new tariffs and not growth. So what's the real cost of this revenue surge, and could it reshape America's economic future? In June alone, the Treasury Department recorded an additional $27 billion in customs duties, pushing the fiscal year-to-date total to $113 billion, a striking reversal from last year's June deficit of $71 billion, now replaced by a surplus. Treasury Secretary Scott Bessent says the government could rake in well over $300 billion in tariffs by the end of the year. It's become a cornerstone of President Trump's economic playbook, protecting domestic industry, rebalancing trade and pressuring foreign partners. While tariffs on Chinese goods have decreased from their peak after an agreement with Beijing, they still remain high. New rounds are now hitting U.S. allies. 30% tariffs on Mexico and the EU, 35% on Canadian goods, 50% on Brazilian exports and 25% on Japanese imports starting August 1st. Economists are sounding the alarm over potential ripple effects that could shake the broader economy. They say consumers may soon feel the pinch as prices are expected to rise and the economy could slow. For more on this, we're joined by Jameel Ahmad, Chief Analyst at GTC. Welcome back to the programme, Jameel. Firstly, this growth in tariff revenue, is it a sign of economic strength or a warning sign of growing trade barriers?
I would say it's the latter, and we also have to look at this as a trend that is going to continue by all likelihood over the coming months, especially considering that we're now expecting once again more tariffs to be introduced as of August 1st. Of course, the reality of whether that happens or not has to be seen because we've had so many different tariff deadlines over the past couple of months, but it's clear that the revenues are being picked up as a result of these tariffs. And when you consider that the threats from the last week of 30% tariffs from the European Union, Canada as well, Mexico, and that these are two of the largest trading partners of the United States. If those do get implemented, then yes, we're going to see these revenues continue to incline. But I'd also look at some of the other news that's coming in that it looks very unlikely the United States is going to make a trade deal with Japan. If you take President Trump's comments last night, that suggests that we're going to have more revenues as well from another major trading partner. So I would expect this to continue, but you're completely right. It's not a sign of economic resilience so far. It's more of a sign of these new times of tariffs and trade wars and picking up revenues through different means.
Now, analysts have sounded the alarm on this tariff-driven surplus. So how could this hurt U.S. consumers?
Well, eventually, you would expect for the increased costs from tariffs to be passed on to consumers in line with anything else you would expect with inflation and so forth. Of course, the biggest problem is that we've been concerned about inflation risks now since the turn of the year, of course, when President Trump was re-inaugurated. But we haven't actually seen the impacts of inflation yet, and that's actually somewhat self-imposed from the Trump administration because of how many times they have gone back and forwards with erratic trade policies. But we are now looking at the August 1st deadline, and we have to take it as actually this time we should have tariffs be implemented. And then at some point towards the end of the third quarter, we should finally start to see what impact this is having on consumers. Because in the moment, it's a bit of a crystal ball moment. We know that this is coming, but it's not coming until it arrives. So the problem is that its expected date of arrival continues to get delayed as a result of these deadlines.
And what could be the broader repercussions of targeting key allies like Mexico, Canada and the EU in the long run?
I think it's obvious that it's causing some stresses to bilateral relations. We have to look at beyond economic partnerships too. There's causing problems there. Essentially, all the institutions are warning of the same thing. It's more signs of the United States taking more of an insular stance and maybe turning away from globalization, so forth. At the same time, it's going to cause global economic concerns. And that's the kind of train of thought that we're following on the same lines.
Right, we will have to leave it there. Jameel Ahmad, Chief Analyst at GTC, thank you very much for joining us.